Hello, everybody. I'm Stacy Scott, and I'm here with Graham Wickham, President and CEO of Wickham Financial and Insurance Services. And we are back again with our weekly wrap-up. Now, as you probably recall, our weekly wrap-ups typically take place on Fridays. But we got to thinking about it. We decided we wanted to change things up because the week still has some time for things to happen on Saturday and Sunday. So it makes sense to push the weekly wrap-up into the beginning of the following week to give you a more accurate picture of the week itself. So with that in mind, I'm going to turn things over to Graham for this week's weekly wrap-up. Graham?
Yeah, thank you, Stacy, and I appreciate everyone being on the call right at Christmas. But I think it was a pretty exciting week. I was actually out of town, hence my, I guess, Santa Claus type beard here. We'll see how long I keep this going. But, you know, I was keeping a very close eye on everything that was going on. And what really hit home with me was the Fed. It was Omicron. It was market de-risking and rotation, hence the Fed and Omicron, right? So let's cover the Fed. The Fed came out last week and said that they're going to lower their tapering, which means they're going to decrease the amount of bond buying, which might take the pressure off rates being low and have them naturally increase, right, to combat the high inflation environment that we're in. They also alluded to next year probably being a bit more hawkish, meaning being a bit more attentive to higher inflation and possibly raising rates quicker, faster. So that's putting some question marks in the market in terms of the economy and the high multiple stocks. Then Omicron, obviously in the forefront, 70% of cases are now being diagnosed with Omicron. So, you know, is that going to be a continued slowdown for the international economies that might now affect the U.S.? Is there going to be a lockdown or shutdown internationally and domestically because of it? What effects is it going to have? Again, all causing a de-risking and a rotation within the markets that we've already been talking to each and every one of you about every week. And as we have meetings with our clients, we've been saying embrace volatility, you know, invest in the areas that aren't what we call visionary stocks. We want to invest in areas that have fundamentals. They got balance sheets. They have profit loss statements. They make money, right? Maybe they pay dividends. They have strong cash flow, strong management, strong product. Maybe a history of raising dividends. So being in like staples or utilities, kind of some boring things, right? Maybe the established large cap techs are going to continue to be the areas that hold up and continue to outperform through the end of the year and into next year. You know, financials look pretty interesting in a rising rate environment, even though they haven't been big performers this last month. So when we think about recommendations and positioning assets for the new year, we want to think about boring, embrace volatility, right? It's there, you got to have it. And let's be honest with ourselves. We've had 2 great years in the investment markets returns. The Dow is up roughly 14%. The S&P is up 21, 23%. I think the NASDAQ's up, 16+%. And the Russell small cap area is only up 10. So we still have some really good returns. But inside the market, we have some stocks, some areas that are down 20 to 50%. So we're having internal rotation. But we think next year, embrace volatility, embrace possibly lower returns for the indices, and embrace maybe a little more boring or unloved stocks that were unloved for 21 that might find some favor in 22.
All right. Well, that's definitely food for thought as we wrap up. But, you know, one thing you have talked about a couple of times, the Santa Claus rally. Is that something we can expect?
Yeah, you know, think about the Santa Claus rally. It's the last 5 trading days of the month, right, of the year, and then the first 2 of the next. And we've had positive returns of 34 of the last 45 sessions. So the odds are, yeah, we're still keyed up for a good Santa Claus rally. Think about the Santa Claus rally as a rotation to the ones that the portfolio managers want to be in, that are in vogue or in favor. Maybe they did some tax loss selling. Also, next year, they have to invest money via mandates within their portfolios or funds, so they have to get some money to work. So it's a pretty powerful time of the year that hasn't really been one you want to miss. Let's put it that way.
Okay. Thank you so much, Graham. And thank you to our viewers for joining us today. I do want to mention that ordinarily we hold our monthly lunch and learn on the last Wednesday of the month. But this year, because of the topic that we have picked, we want to go ahead and host that tomorrow, which is December 22nd at noon. We're going to be talking about some tax planning for the year end, and as we wrap things up, some things that folks need to look at, and we want to give you plenty of time to do that with the extra week before the year ends. So please join us tomorrow at noon for that, and always remember to check back on our website and our social media accounts, because we do put really current and valuable information on those as well. And just want to take a moment to thank you again for joining us and working with us. And we look forward to working with all of you as we go into 2022. So thanks so much and have a great holiday. Bye-bye.
Merry Christmas.